If someone was going to buy an investment today because they agree with us and they think that's a good bet on the future and it's a good thing for society to do it, and they want to have the courage to act and to go out and do this, what would you advise them?
Personally, my view is just focus on the cash flow.
Yeah.
You don't worry about the buying the chocolate box villa, whether it looks pretty. The intention is not drive your friend past and show off about the beautiful house you've just bought. You want to impress your accountant, not your friends.
Yes. Yes. Welcome to the LoweDown, Wellington's #1 real estate podcast. This is episode 10. I'm here again with my great friend, colleague, business partner, and actually an avid property investor too, Adam Cockburn. How are you, mate?
Hey,
Back here
good.
again.
I'm good, Craig. How are you doing?
Yeah, really good. Now, we spoke a couple months ago about why it was such a good time to buy a house. And we really focused kind of on, I suppose, first-home buyers as well as investors. But today I think we just wanted to go a bit deeper on the investment property side and kind of go into some of the numbers, really take a deep look at why it's such a huge opportunity, because I think we both agree on that, don't we?
Yep. Yeah. Well, I think right now is like a fantastic opportunity. I just think everything is lined up for making right now a great time to buy an investment property in Wellington. And I think it's important just to sort of, to start out, to say that we're not saying that if you buy an investment property now, it's a great time to buy now because in a year's time it would have gone up in value. We're not talking about short-term speculation. We're just talking about it's more likely that you can get good value today that over time will see you delivering or reaping the benefit of above average returns. And by returns, I'm sure you agree, my philosophy is the future cash flow that will be delivered from that asset.
It's a good point. People really get this wrong, don't they? I mean, I mean, I don't know about you, but I find, you get people that talk about the difference between capital gain and cash flow, where I think you and I are aligned on the fact that those are two sides of the same coin, aren't they?
That's right. I mean, I certainly think that, I mean, ultimately, if you have a handful of investment properties in 20 years' time, how will you have gotten your wealth? Most probably you would have gotten your wealth by the increased value of those. The asset value is grown, whereas the debt has not grown. And so, yes, your wealth is delivered by the increase in value. But the increase in value is a function of the increase in the cash flow. And the strong cash flow makes it easy to hold on to it for a long time.
That's right.
Yeah,
that's right. And then and people, when they talk about, and I think this is why your family home shouldn't really be considered, an investment asset.
That is not an asset. Is something that puts money in your bank account every month.
Yes, exactly. And in terms of your family home, you're always going to need somewhere to live. Right, so unless you're going to sell it and rent somewhere or whatever, I mean, what good is it? So it's kind of dead money anyway in that sense. So it's incorrect to think about your house as an investment, and unless you're a speculator or a developer or something like that, or a trader of land or that kind of stuff, then really what we're talking about here is
that's not an investment either.
No, it's a speculation, exactly. Yeah, and so if we're talking about investment, we're really talking about cash flow.
Yes, long term.
And even if you do speculate on something, you go and buy something, say a piece of bare land, you say, I want to wait for that to go up in value, and you speculate on that. Even then, the problem is you are constrained in what you can then do. So you have an opportunity cost. If you don't have any cash flow on it, you then can't actually take advantage of another
well, you've got to earn money from elsewhere
just to hold on to it.
In order to hold on to this thing, let alone the opportunity cost of that capital that could be out there earning an income. But to dig into the details, Craig, I mean, I think there are many things right now which are leading me to think that today or right now is a great opportunity for property investors to get in Wellington. And I mean, the first thing to start with is just by a long-term fact about Wellington, and this is not particular to today, but it hasn't changed, and that is that on average, Wellington households earn more than any other place in the country. It's been that way for a long, long time. Is there any particular reason why that would change in the future? So what? That just means that there is more ability for Wellington households to pay rent than elsewhere in the country. And that might explain, and no doubt it does explain, because rents tend to follow incomes. Rents don't tend to follow mortgage rates, or at least not closely. So if there's more income available, then there's more capacity to pay rent, right? So Wellington's just a lot of ability to pay rent because the income of Wellington households is higher than anywhere else.
Why is it so high? Presumably it's a government sector, small city, concentrated with a lot of government workers.
I haven't dug into that myself, but I suspect that you have less variability of the income in Wellington. You won't have, like in Auckland, I'm sure you've got more people earning right at the top end. And probably more at the lower end too. In Wellington, there'll be less spread, more concentrated around the middle, but on average, it's higher than in Auckland. Not by a huge margin, but by a bit, yeah. So greater capacity to pay rent in Wellington than anywhere else.
Now, right now, interest rates, even though they are about to start the sort of downward cycle, they have started.
Well, they have started,
but overall, they're still higher on average than they have been over the last few years.
Yep.
So I think it's good to explain to people, like, we think this is a great time to buy, but people are probably looking at higher interest rates. They're looking at the tax deductibility of interest hasn't fully come back yet.
No, we're at 80% now. 80% going to 100% on the 1st of April.
Yep. And then rental property, as we talked about in our last podcast, the rental market's really bad. It's hard to rent things at the moment.
Yep.
So if we look at all of those three things, you might say, well, why on earth are you guys saying it's a great time to buy?
These all suggest that it's a bad time to buy, right? Well, that's first order thinking. Second order thinking is, yes, but where are they going? And interest rates, yes, they're high, but where are interest rates going? They've already started the decline. They're going lower. Now, I'm not sitting here predicting what the interest rate's going to be, but all the commentators are suggesting it's going to drop by another roughly 2%. The OCR I'm talking about here. So obviously, if you can take your interest rate today and reduce it by 2%, what difference is that going to make to your overall cash flow? That's creating a whole lot more profitability.
It's massive. 2% is absolutely huge.
Massive. Right? Now, as you've said before in previous podcasts, you what did you say? You marry the rate.
You marry the property and you date the rate.
You marry the property, you date the rate, right? So what that means is that it doesn't matter when you buy the property or when you take out the mortgage, you will be paying the same interest rate as people who buy in 2 years' time.
Yeah.
In 2 years' time.
Yeah.
Okay.
Over the lifetime of the asset, your average is going to be pretty similar, no matter whether at what point you buy, right?
So the thing that's more important is the price you're paying.
That's right.
And we've established that prices are down by a long way. And when the interest rates come down, it does several things. One is it creates headroom, it creates more profitability in your cash flows as an investor, but it also increases the demand from other investors. And so is that likely to put pressure downwards on prices or upwards? Upwards,
yeah.
Right?
But what we're really talking about here, going back to the cash flow point, is we're talking about yields because we know that the cost of capital, right, which we could say in real estate terms is really the interest rate you pay. Let's just say your cost of capital, as that goes down, right, then yields or go up, don't they, relative to interest rates? So the other way around. As your cost of capital goes up, yields rise as well because people are pulling money out of the asset that's creating the yield and they're putting it into safer risk-free kind of assets like interest, like paying off debt or putting money in the bank and earning interest where it's risk-free.
Yes.
So taking it out of risky assets, and so therefore yields go up as interest rates go up.
Yeah.
And so when you buy knowing that the interest rates aren't going to stay high forever, you buy it high, then you know that the yields are going to go lower, which means that the whole value of your asset increases.
Exactly right. So in other words, as interest rates come down, investors who are looking to buy will tolerate lower returns on the asset they're about to purchase because the risk-free rate in the bank or with a bond and so on is coming down. Therefore, they will tolerate a lower yield on the asset that they're purchasing. And a lower yield corresponds with a higher
price
value, right? Yeah. And the same is true when rents go up, of course.
Yep.
Right? So yes, we've got interest rates which are heading down, which is going to create a lot of surplus cash flow. What about the supply of rental accommodation? What's been happening in the last few years to the supply of rental accommodation?
It's been going up. Massive increase in the amount of...
Sorry, I'm not talking about listings on Trade Me, but you're absolutely right. The number of listings on Trade Me has absolutely gone up, which means that it's a good time to rent right now. And again, like you said before, that would suggest now is a bad time to buy an investment property. Again, first order thinking, right? Second order thinking is it's never been this high, the supply that available. And so it's likely to tighten from here, which is going to drive rents upwards. But what I'm talking about is the actual number of houses that are out there in the market that are available to rent, whether they're occupied or not.
So baby boomers are selling investment property, right? We know that because they're looking to retire. So they're more of a net seller than net buyer. I mean, really, investment property is a long-term asset, isn't it? It's not something you flip in a year or you buy for a 2-year time. You're sort of in for the long haul when you buy a rental property, which is a good thing. But someone who's 70 years old. And my parents are well into their 70s. They're not going to go and buy a rental property now. And I mean,
they're sick of maintaining their rental properties.
Yeah. So I mean, it's really something that is a younger person's game. And so if we look at the baby boomers who own a lot of investment properties, they are net sellers. And then I think you've got a bunch of reasons why people aren't buying them, which we've already discussed. And there's a few other things too. I think culturally, it's perhaps not as popular as it was. That dream of a second home and renting it out. Perhaps people are now looking at you as a bit of a greedy landlord.
You're vilified.
You're vilified a little bit, and you're sort of so there's kind of a cultural change there from younger people not wanting to do that.
There was also a very big. There's been enormous change in the last 3 or 4 years, especially since early 2021. You will remember, of course, the Ardern government changed the legislation, the tax legislation, so that mortgage interest for property investors was not able to be claimed as a viable tax deduction.
That was like, I mean, they've been throwing stones at the glass house to try and crack the property market for years before that, and that really smashed it.
Well, that destroyed the business case, didn't it? It completely destroyed the business case. I mean, mortgage interest is typically the biggest expense by far of the property investor. It's a completely valid business expense for them, and they were not going to be able to claim a tax deduction against that, which means their tax bill, they're paying an enormous amount of tax on profit they're not making, right? So that crushes the ability, the cash flow for the property investors. Now, in that environment, why would property investors go out and buy residential real estate as an investment? They simply wouldn't, and they haven't been. Now, are there exceptions to the rule? Completely. But overall, the number of investors buying in the market has dropped enormously.
Massively.
We're starting to see a little activity come back because the rules have been reversed, because interest rates are coming back down again. But there's no way you could sit here today and say that property investors are out there in force in the market.
So way more sellers than buyers. And that creates an opportunity in itself. And then if we look at, like, if we just forecast out the future, you say, well, what is this opportunity? What are we actually talking about? I mean, I would characterize it like this. You buy today, you're buying at a lower price, right, with a higher yield. And then what's going to happen is you're also buying with the potential for future rental increases.
Yes.
So the idea is...
Because the supply is so constrained.
Exactly.
The supply has not been increasing to the level it ordinarily would have been.
Exactly.
Eventually, demand is going to come back.
Yes, that's right.
And when demand
that will squeeze the rents, right?
When the demand comes back, what happens to the overall number of houses that are available, not just available on Trade Me as an empty today, but the total population of rental accommodation? Very inelastic.
So
you cannot increase the supply of rental accommodation overnight.
No, that's
correct.
Right. That's right. It's a big lag.
It's very
huge
slow.
Huge lag. So if we say over the next 10 years, your returns are going to come from multiple sources. They're going to come from increasing rents, which increases your overall cash flow, lowering yields, which increases
which increases your capital value.
Your capital value goes up, and then the other thing that's going to happen is buying rental property is going to become more popular as well, which will also increase the value and lower the yields. And then, leverage, right? So
rents are going to go up.
Obviously,
because of the constrained supply.
And I would imagine banks, one thing we haven't talked about, but another thing that's been at play and is still at play now is banks are not as loose as they normally are in terms of lending. So we've still got...
Banks are still pretty conservative.
They're still conservative and used to be that you could lever up and you could buy, probably sort of 10 or 15 rental properties over a decade by just continually leveraging. Whereas that's much, much harder to do today. But one would imagine that that's a cycle too, and that eventually, money will get a little bit easier for investors to find, and that will also increase the demand, which then will also add to your returns. And when you layer all these things on top of each other, that's why we see this as being such a big opportunity, right? Because over the next 10 years, all of those things come right, and all of a sudden you've got a much more valuable asset than when
so many drivers that will lead to rents going up. Demand increasing for rental accommodation, and the supply has remained constrained. And the other thing, of course, is building consents are down. Right, building consents are down. They're down significantly, but not nearly as low as we saw coming out of the GFC, for example. Right, so that might suggest that as we come out of this, as we go to the next boom cycle, we're not going to see quite the outsized level of capital gains that we saw perhaps then. But the interesting thing is that if we look at building consents by region, the Wellington region building consents have dropped by 39% versus a year ago, more than anywhere else in the country. So the constraint driven by a slowdown in construction in Wellington is a greater constraint than we'll see anywhere else in New Zealand.
Underbuilding it'll be a huge topic in about 5 or 10 years. Won't it?
Yeah, that's right. That's right. What else is now? This is an interesting one that I wasn't so aware of, and this is going to be perhaps an unpopular thing to say, and please don't cancel me for reporting the facts, right? But if we look at the numbers of how much of Wellington's household income is being spent on rent, it's the lowest it's been since 1992.
Wow. Yeah, that's fascinating.
That's 32 years.
Yeah.
Now, I know that rent doesn't seem cheap, but as a function of on average...
Relative to how much money you're bringing in.
On average, at least, relative to the amount of money a household is bringing in, rent is taking up, typically in New Zealand, rent takes up about 24% of household income. And in Wellington at the moment, it's barely over 20. And it's lower than it's been, as I said, for 32 years. So that doesn't mean rent should go up. But what it does mean is that when the supply-demand balance reverses, because things do tend to revert back to the mean, don't they? Right? And at the moment, we're at an absolute extreme with the amount of supply that we've got available and empty properties, that sort of thing, and the rental market's very favouring tenants at the moment. When it reverses, there's an enormous amount of headroom for households to pay more rent. The capacity for them to pay more rent, according to that data, before they revert back to long-term norms of 24-25% of household income, there's a huge capacity there for when those supply-demand does revert. Yeah.
And like, just if we talk about the social good of this for a second, because I know, there will be people out there that would be cynical about this, but the reality is that we need investors, don't we?
Oh, we absolutely need investors.
For some of the reasons that we've been talking about now. Like
yes.
you need to increase the supply of rental properties.
Yes, if the more investors come in and buy and supply rental accommodation, the less the market will be tight, and the less rents will have to be forced upwards to balance that supply.
But the importance is to be a good landlord, right? Like we're talking about high quality, provide high quality accommodation, keep things really well maintained.
Yeah, and you can't do that unless you're getting a reasonable rate of return.
Yes, of course.
Unless you're getting enough money coming in versus money going out, there's nothing left over to maintain the property.
So there was never going to be a long-term solution. The deduction, the lack of being able to offset your interest.
One thing we've talked about in other podcasts, Craig, we've sort of touched on, but is also very relevant here, is the student population. So Victoria University numbers, I understand, going from 2021 to 2023, 15% down, and then from 2023 to this year, 2024, about the same. So 15% down on 3 years ago in terms of overall student numbers. So that obviously has a big impact on the number of students that are out there looking for accommodation. But the other thing that happens is because you've got that capacity, there's room in the halls of residence. So I understand that the universities are offering rooms in the halls for typically after you've done your first year, you then exit the halls and you go into the private rental market. But because they've got capacity, they're offering the rooms for years 2 or 3. And so even though you're 15% down on student numbers, you're even more than 15% down on numbers coming out into the private rental market because they're staying in the hall for longer. So when that reverses and the universities really get their act together and build the student numbers back up, which I'm assuming they will, otherwise they're permanently, loss of business. So if that does happen, then you have this massive influx of students coming back into the halls, and all of those extras that have been residing in there will get squeezed out again, and so you'll get the reversion will happen and get this massive, more than 15% more students coming out of the halls back into the private rental market. So again, I mean, we've seen articles in the press talking about the shocking, horrific conditions in the rental market in Wellington, and with a photograph of a line of people outside the street and going round the corner, queuing up to have a look at a flat in Mount Vic or Mount Cook or whatever the case might be. You can just see that's coming again.
I agree.
If indeed that happens. Yeah.
And so, what makes a good rental property? I mean, so a good investment. If someone was going to buy an investment today because they agree with us and they think that's a good bet on the future and it's a good thing for society to do it, and they want to have the courage to act and to go out and do this, what would you advise them?
Personally, my view is just focus on the cash flow.
Yeah.
You don't worry about the buying the chocolate box villa, whether it looks pretty. The intention is not drive your friend past and show off about the beautiful house you've just bought. You want to impress your accountant, not your friends. Yes. So I would focus on something that delivers a high yield. That is the amount of rent you're getting as a function of how much you're paying for the house. And also, you want it to be something that doesn't eat up an enormous amount of costs in deferred maintenance or an enormous amount of your time in managing the property because of tenant problems and that sort of thing.
And so would you agree typically, I mean not always, but typically we're talking about multi-flat type, like properties that have traditionally been, rental only. They're not so much, in the market for a buy that a person would buy as an owner-occupier.
Yep.
They're more like the big old villa that's been split into 4 or 5 flats or 3 flats or 2 flats, something like that. They tend to have the high yield, don't they? So,
multi-income properties. I mean, I like home and income properties that potentially in a better market can be sold to people as homes.
What gives you more flexibility,
more exit strategies, more target markets to exit to.
Even those have a slightly lower yield than the pure investment, I find.
They often tend to. Just watch for the ones that have so much deferred maintenance that all of your surplus cash flow ends up going to paying for that. So it looks good on the top line, but once you tumble the numbers through to the bottom line, it doesn't. But typically, the properties that aren't so sought after by the owner-occupiers and therefore the prices are not bid up.
Yep.
And that would include, let's put it bluntly, ugly properties. The tenants are not so worried about the cosmetic appeal of the curb appeal, if you like. They just want something that's clean and tidy and, most importantly, well located.
You're going to pay more for pretty.
That's right. You've got to pay more for pretty. Stay away from the pretty.
And so if we were to wrap things up, I mean, I would summarize this entire conversation as being, having a counter-cyclical, doing the opposite of the crowd and actually looking at everything and saying, well, everything's bad, so therefore I want to jump in.
Yes, exactly right. Everyone else is thinking that.
Yes.
But again, we've mentioned a couple of times, sort of like second order thinking. If it's this bad, things can only get better.
That's right. So mean reversion to some
So if things can stack up today or get close to stacking up today, boy, are they going to look good in the future. But have you noticed that it's a lot easier to read in an investment book that you should be a counter-cyclical investor? That sounds like an obvious and an easy thing to do.
Much harder to actually do it.
Actually doing it when everyone at the barbecue is telling you about how risky it is to be in real estate right now and how terrible the rental market is right now, that takes a huge amount of courage and personal conviction.
We follow the crowd, don't we, at the end of the day, that as a bias. One other point, though, is it's a tough time. I mean, there's not that many people have got cash. So there's another factor as well. And it's
quite hard to raise the money.
It's quite hard to raise money. So it is a luxury to be able to do it. But for those that can, it's a great time. And we are going to need that market to come back.
That is true.
Look, absolutely fantastic discussion. I think that's hugely valuable for people, Adam. That was the LoweDown. Like and subscribe. We'll be back at it next week. And thank you very much.
Thanks very much.